Good afternoon, this is David Kearns on the Money Core trading floor on Friday the 12th of March, bringing you our weekly commodity currency market update. What a horrible week it's been for the pound, and certainly when you compare the pound against those countries that are closely linked to commodities. We have seen yet again new lows against the Australian dollar at 1.62, also against the New Zealand dollar just below 2.11, and also the Canadian dollar at 1.5275. We started off this week with the UK's trade gap widening even further to a record deficit of £8 billion. The weak pound has had surprisingly little impact on our ability to export our way out of recession, and with exports showing their sharpest drop in more than 3 years, investors saw good reason to sell. Next we saw both the UK's manufacturing and industrial production numbers, which are used to measure output, both dip back into negative territory, further signalling concerns that the first quarter's gross domestic product number, which confirms overall productivity, will show either a decline or even come in as a small negative reading. Also, with the opinion polls in the UK highlighting that the Labour and Conservative parties are now neck and neck, the concerns of how exactly a hung Parliament will be able to implement the much needed fiscal changes required to rein in public borrowing deficits sends shivers down investors' spines. Sterling will remain on the back foot until we see one party emerging as an outright winner. Whilst the UK economy flounders, Australia's economy steams ahead. The demand for raw materials from its Asian neighbours has seen a dramatic rise in the demand for skilled workers. Australian advertisements for job vacancies surged by 19% in February. It is hardly surprising then to see their business confidence numbers press higher still to a 4-month high. The number of Australians employed did rise, but only very marginally. The Aussies though did get a rather a surprise when their home loans data for February was published. The fall of 7.9% was largely attributable to the phasing out of last year's first home buyers grant, and most certainly by the rise of their interest rates, which now currently stand at 4%. Over to the New Zealand dollar, that has remained fairly strong and was certainly helped by their very encouraging trade figures, which show signs that their economy is gathering strength. New Zealand firms appear to be gearing up their internal investments, which will help drive productivity levels higher. The Reserve Bank of New Zealand left its official interest rate unchanged at 2.5% as expected, but will likely hike rates in the second half of 2010. Further encouraging signs of improving conditions also came from the increase in their retail sales numbers, which rose by 0.8% in January. Over across the Atlantic, Canada has so far this week seen just two interesting releases. Firstly, we saw February's housing starts rise by 6.1%, which was far higher than expected. The residential housing sector is considered an important area which will help lead the Canadian recovery. We then saw a far better than expected trade surplus from Canada, with exports rising and imports falling. Obviously, the American recovery is certainly increasing demand for Canadian products. Overall, it has been a week of turbulence for the pound, whilst trading nations which have strong ties to commodities continue to strengthen, whilst the global powerhouse of China looks for and demands ever more raw materials. For more information and to contact us, please visit the emigration pages of our website, www.moneycore.com/emigration. Have a great weekend.